Welcome to Crypto Clarified, Investing in the Truth, a podcast series where we come together to discuss the most captivating headlines and trends from the investing crypto space. My name is Benjamin Dean. I'm director in WisdomTree's digital assets team. I'm joined once again by the one and only Jason Guthrie, head of digital assets product at WisdomTree. Jason, how are things?
Things are good. Markets are the worst, but other than that, I'm not going to complain.
You got to be optimistic in these spaces, right? Like every day is another day. If you're in the US, by the way, join the waitlist at WisdomTreePrime.com. You won't be disappointed. Jeremy Schwartz is here with us. Jeremy Schwartz, sir, the Global Chief Investment Officer at WisdomTree. Jeremy, how are things?
Ben, it is a pleasure to be on Crypto Clarified here for the first time. Love your show. Thanks for having me to talk a bit about what's happening in the global markets here today.
Absolutely. There's tons to talk about. Check out Jeremy D. Schwartz on the Bird app, if you like. Today, we're going to be talking about macro and how crypto is holding up. We're going to talk central bank digital currencies, CBDCs. Nice acronym. And then at the end, we might have time for a Mythbuster. But before I start, I have to give the usual shout out to James and Sam in compliance. Before I begin, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. Now the housekeeping's done, let's get on to the fun stuff. Jeremy, you are a longtime colleague and confidant of Professor Siegel, and over the weekend, the most popular person on the Bird app is someone who's not even a member of the Bird app. Jeremy Schwartz has been utterly hilarious in his remarks about the Fed. What is going on in macro land? Let's start there because then it can turn to how we think about it in the crypto space.
Yeah, he's not thinking it's that hilarious. I mean, he was fired up. I mean, I've worked now with him 21 years. I was one of his undergrad students at Wharton in 2001. Worked with him on his book, Stocks for Long Run, 3rd edition, first project. Actually, the 6th edition, just hitting the bookstores. So if you're interested in a lot of his long-term research. We also talk about the pandemic, and actually what has him fired up right now is a chapter in the book on the pandemic, the response to the pandemic, and all the issues it was creating. And, he was very early calling for inflation. He thought it was going to be a big problem. Really early in the pandemic, he saw what the governments were doing, all of this, the stimulus, the fiscal response being supported by money printing, the central bank buying bonds to support the situation. He said there's going to be inflation. It's going to take some time, but when we open the economy, there will be a lot of inflation. And the Fed wasn't willing to say there was going to be inflation. They were on their transitory narrative. He was calling them out. And now he's calling them out again because he says everything that shows, all the data shows that inflation is receding. It is going to be less of a problem. All the commodity prices are receding. Housing prices are receding. Real estate is going to come down because mortgage rates just hit 7%. Like, how do you not see that home prices are going to come down? The month over month from 3 months ago is coming down. Yet the Fed is saying these backward-looking inflation statistics, which are going to keep rising for maybe 12 months, is causing them to keep raising rates. And it's like slamming on the brakes and crashing us through the windshield. Why do we want to do that? So that money supply gauge that he said was going to create inflation is now printing negative. And sort of if you I did a tweet thread on this. If you find that on my Twitter, as Ben was saying, you've almost never had 5-month changes in money supply being negative. You want the money supply to grow 5% a year. And this is from his class that I took with him at Wharton. MV equals PY. The money velocity times money supply equals inflation times real growth in the economy. It's a formula they teach in all finance economics 101, what he teaches. And so that money supply exploding, leading to inflation, you keep real GDP constant, but you want 2% real growth, 2% inflation, that gets you the 5% money growth. You don't want money supply printing negative. So that is We just got the latest data this week showing, again, the 5-month decline. So Siegel's fired up. Now you're seeing today, as we're recording this, Ben, you have the Bank of England blinking. They see rates spiking, and they're like, we're going to sell bonds. No, we're not going to sell bonds. We're going to actually start buying bonds. We can't have these bonds rising. Like it's amazing. So the Bank of England blinked. The Japanese central bank was intervening in the currency markets, yet they didn't change their policy. I mean, I don't understand the Bank of Japan thinking that they can control the yen without changing their policy. But, what the Bank of England shows is even if they were raising rates, the Bank of England still has enormous pressure on their currency, and even more pressure today after they took the action. So they're all in a very tricky situation. The dollar has been soaring. Risk assets have been off. Crypto, to our crypto clarified discussion, has been trading as a levered play on the NASDAQ in many ways. It sort of moves early. You often look for signs of what is crypto doing, then you see that show up in the equity markets a little bit later. I saw some relative strength in some of the last week. It'll be interesting if it can find a bottom. The markets right now, things are so volatile. It's hard to say from when this gets recorded to when it goes out, but it's all trading up bond yields. We're all bond traders now. Bond yields being comforted at the moment from the Bank of England, and so risk assets. You see some green on the screen at the moment, but there's so much volatility. I think the Japanese central bank will be one of the next key contributors to bond yields rising. They're not going to be able to keep their rates pegged at zero for a while. And so you saw what happened with the Bank of England. I mean, we're all trading off the Bank of England now. Eventually, we're going to be trading off the Bank of Japan on bond yield. So there could be more pain until you get the Fed to pivot, admit that Siegel is right and they are wrong.
So you think this is
hold on
a
second,
central?
Like, you just said volatility, right? Like, what is the least volatile thing at the moment? And I say that relatively speaking. Jason, like, how does this all translate in crypto and what's going on? Because I haven't seen this thing as quiet in a couple of years.
Yeah,
And the
I know
macro
you're
backdrop is
referencing.
fascinating.
I know you're referencing sort of like the last 3 months, right? And Bitcoin, Ethereum pricing, even with what we've seen, the kind of bit of a sell-off around the Ethereum merge. But relatively speaking, it's actually one of the least volatile asset classes over the kind of the last 3 months. I tend to take the same sort of view as Jeremy, that it tends to lead, right? Like if there's going to be a risk asset sell-off, what's the first thing that a speculative investor sells? Well, it's probably going to be their crypto and then their equities and then their bonds, right? As they try to move more and more of the portfolio to cash. But like you're right, in the last 3 months, it has been the least volatile thing that I own, which is not a usual state of affairs.
I think it's interesting. Like for a while, you could say there's this question of, is it going to be less correlated to the markets over time? Well, within crypto, with Bitcoin and Ether become less correlated over time because a lot of people trade them together. And for a while, it was under the radar of the true hedge fund trading community. And you could say it marched to its own drum. The more it gets institutionalized, the more it gets into more traditional portfolios, the more it gets subject to some of the same risk on, risk off features. But over time, I do believe things like Bitcoin, Ether will have very different market drivers. Would you both agree with
that? I would also think that it's completely different groups of people that are driving like the moves down versus the moves up, right? Like people during the pandemic when we had this huge market sell-off, like I would argue it felt more panicky than what we've got now on a cross-asset basis. Bitcoin sold off really hard, right? But it was also one of the first things to come back. It wouldn't surprise me to find out that the people causing the sell-off were the slow accumulators, the more traditional investors, the more long-term guys, were really selling off when there's kind of blood in the water and when there's a bit of panic about what risk assets might be. And then once that kind of bottoms out and the fear abates, the kind of evangelists that held through that sell-off are going to be the ones piling free cash back into it. It does have very interesting kind of mechanics as to the fact that it sits across this, what is an increasingly large cross-section of investors that act for completely different reasons.
Yeah, you've got the hodlers of last resort. For the listeners here, as of kind of yesterday, gold has sold off 10% in the last 3 months. The MSCI World has sold off 7.7%, and the digital assets 100 sold off 4%. It's like in a world where everything's burning,
Relative
And
outperformance. That's pretty wild stat. So I do think that's what we're talking about, like relative performance looking pretty good. Um, I do think some people have thought about it as, you think about in the equity world, my world's mostly, the factors that have worked, the zero dividend payers, the non-cash flowing, unprofitable firms, by far the biggest declines, high dividend stocks with cash flows. Even year to date, just the other day was positive on the year. So massive spreads over 2,000 basis points within the U.S. equity markets. And it's really been a global phenomenon. Emerging markets, which are under pressure, China tech selling off, higher dividends outperforming, same in developed international. And so you could say, well, crypto has kind of got some of this techie oriented. It's not, there's some of them that are starting to offer cash flows, but a lot of them are not your traditional cash flowing security. So it's sort of a higher duration asset from that perspective, somewhat like gold. So then, it has more competition with bond yields rising with the flight to safety trade. But it's very interesting to see, as you're saying, the relative outperformance in this is tough last 3 months.
Jeremy, do you think there's like an element here where you just said like it's not yielding, there's no dividends? Like Ethereum just moved to proof of stake, and so that does provide a staking yield
Yes.
reward. Like, do you think that's changing the way in which folks view the space from the institutional angle?
Yeah, so I early on did. I have a podcast also, Behind the Markets podcast, and we had done there was a Twitter sensation, Squishy Chaos, I want to say his name was, that did a paper, like a 70-page paper on Ethereum, the triple halving, that after the merge, after the staking, all these things, like the amount of less supply was going to be like a triple halving in Bitcoin. And so there was I think there's a lot of interest in that post. And I do believe the less supply that's coming from the merge and from the staking and all that does change the calculus a little bit. I think Jason, I don't know if you've talked with the legal folks to say, there's been Gensler coming out and saying, are these staking yields going to change whether it's a security? Mm-hmm. That is one of the questions. You were Bitcoin and Ether were being viewed as these non-securities. The SEC's let futures trade on Bitcoin. Will the staking change that dynamic? I don't like to hear that from Gensler. But
I don't like to hear much from Gensler these days, if I'm honest, mate.
Gary's
Yeah, it might. I think the chat it's definitely around, that, at least in the financial spheres, as to whether it's going to be treated as a security asset. But I think that really only affects like those that are looking at it from a purely investment perspective, right? Interestingly, someone we were dealing with asked me, like, surely they thought about this when they were considering the merge. Would they have not got some legal opinions? And my response was like, I don't think they've ever considered what the SEC will think of what they're doing for their software updates at all. And for people that are building this software who believe in the ecosystem and decentralization in building dApps and DAOs and, DEXs and all of this DeFi stuff, it's not about whether it's treated as a security or not for the US market and what the native token is going to be, but really about like the power of that kind of software. And I think if you're coming at it from an investment perspective, well, buying a security is not that difficult anyway. So even if the SEC does treat it as such, okay, great, you'll need to buy it through a regulated broker-dealer if you're a US investor. Whatever, you've probably got that relationship already. And what you would continue to be speculating on is the like retained value in that network providing utility. So, that's a very long way of saying maybe they do. I'm not sure it matters.
But most of them aren't even domiciled in the United States. Like, this global network, it runs on the interwebs, right? Like, you write software, you can live wherever the hell you want. You can push the software via GitHub, and it's like, yeah, it's out there. Like, the assumption that the SEC has to tick off exactly what you're doing is an interesting one, that you even think it's an assumption for someone domiciled in Kazakhstan, the People's Republic of China, or the Philippines. Like, that. It's just not how software works.
I do think the narrative needs to change around this a little bit. Like in terms of, I think regulation is really important. I'm on the record a million times saying this, that it's going to be a huge driver of how more people get adopted into this ecosystem that's going to add a large amount of value. So regulators need to be part of this conversation, but they do need to change the way they think about this a little bit. It is an organic ecosystem that is growing up out of like open source software and like individuals putting effort into it. And I think if you want that benefit, you need to encourage that innovation to be happening in your jurisdiction. So the way in which they need to go about regulating this is not about slapping these labels on things and think it's going to happen, but really trying to understand like where this is coming from and how they can encourage people to build this stuff inside their domicile where they do have jurisdiction, and to give people a framework by which they can, prosper, where they can really drive this innovation, whilst at the same time putting their hand up and saying, hey, I'm happy to be accountable for what's going on here. I'm happy to be accountable for the user experience within it. Because that's really what you want, right? You want people that work in financial services to do it in a place where they're accessible by the regulators. And if they do something dodgy or they do something that's not above board, or they try to take advantage of someone, or their disclosure's bad, or they break a rule, the regulator can come and find them and put them in jail. And if you're on the hook for it, you take it seriously. And that's what they want. I mean, that's how the system works today. It's how they should want it to work here. The wrong way to go about it is slapping too many labels on it that makes it too difficult to actually drive that innovation from your jurisdiction. And then it happens nominally in Kazakhstan or the Cayman Islands or Singapore or wherever. And then you have no jurisdiction over it, but you're not going to shut the internet down. So hooray, you've lost control. You need to encourage this innovation in an environment that you've got control, where people want to work with you and want to take responsibility for what they're building. And I think there's plenty of people out there. It's always been our approach to what we're building.
Let me just do 30 seconds, Ben, jump in. I'm going to give a shout to the European regulators on this. There's always this reputation on, the tech companies are headquartered in Silicon Valley. Europe doesn't have any of the big tech companies. And, that's one of the reasons why the U.S. outperformed the global market for the last 15 years is big tech dominating the U.S. The U.S. has made it more difficult for investors to get access to crypto. We still don't have a spot Bitcoin ETP or ETF. Yep. In Europe, you guys not only have those kind of products, you have baskets, you have further down deeper coins. They're starting to allow staking in those products. Mm-hmm. So I'd say the European regulators have embraced a much more forward-thinking regulatory approach to allowing the innovation, allowing the products. They found a way to do it compliantly with the rules. The U.S. is I don't want to say at risk of getting left behind. Maybe say they're better off for not, following the trend if you're one of those crypto haters. But they are. I give them a shout in Europe regulation that they're actually allowing this innovation to happen, finding a way to work with companies and do it responsibly, which is what the companies in the U.S. want to try to do.
It's really interesting. Like I agree with that for where we kind of have got to today. I mean, I don't necessarily agree with sort of things like Lagarde is saying about the sort of CBDC digital euro. We'll get to that.
Topic.
But for this point, you're right, and it's really interesting that sort of they have sort of this disparate or decentralized kind of regulatory setup in Europe, where each country's kind of got its own. But if one approves it, everyone else does. In lockstep, they're forced to, because of European rules, to sort of respect what the other one says is okay. Whereas I contrast that to the US, and the multi-agency bureaucracy seems to be really tying them up, right? Really tying that. Like I think that the tone that is coming out of the SEC from Gensler in particular is actually contrasting quite heavily to what we hear from like Office of the President or the Fed, who actually want this innovation who seem to want this innovation to be occurring on shore, versus like this very hardline approach that the SEC and Gensler seem to be taking. So it's interesting that, a lack of European bureaucracy is actually the thing that's got them going, like very shockingly.
Yeah, it's the contrast is amazing. As someone who lived in Washington, D.C. 5 years ago, when I used to say to people like, Bitcoin's a big deal, you better wrap your heads around it. Like, what's Bitcoin? The change in the last 5 years is striking. And then to see it on this other side of the Atlantic as well, yeah, it's kind of a benefit you get from different regulators and different authorities across Europe. They have different approaches, but some are more progressive than others. You have touched on something, though, that's important, and we should discuss in detail somewhat. We know during 2021, the number of stable coins, it's kind of it's a funny term in a way. US dollar pegged tokens went from around $6 billion US dollars equivalent to $160 billion US equivalent in the course of a year. the ironic thing about the crypto ecosystem is one of the most wildly popular things is US dollar peg tokens. Now, the central banks have noticed this. And in a way, like, they now talk about central bank digital currencies. Look, most of the money supply has been digital since the 80s. Yeah? Like, it's not new. Money is already digital. But the idea that the central banks have been turning up around the world and saying they're going to release their own CBDCs is interesting. As a starting point for the discussion, we can explore what that means because it's a vague concept. But the European Central Bank's president, Madame Lagarde, has said she does not like to see a period of free banking due to cryptocurrencies. She says that central bank digital currencies, CBDCs, are required to maintain the role of central banks. Now, I don't want to throw everyone off on a duck hunt here, but let's talk about, Jeremy, central bank digital currencies. What does that term mean, and what are these people on about?
Yeah, and there is a question of like, what is the role of this sort of digital dollar that you're talking about? Because we can transact in some ways, but the cost to globally transacting can come down. The sort of money transfer protocols can be settled much quicker than it is today. And if we want to be competitive, you need to enable that type of technology. Now, China was early experimenting in some of this, and they did these currency drops to their people. And with China, there's sort of further worries about being a surveillance state, that they're doing this so that you can track all sorts of the money supply. And actually, even when India, India is known for all this sort of black market activity, corruption, payments, avoiding taxes. And so what did Modi do? Very unpopular. He banned the very large bills. And so you had to have, if you wanted those values, you had to put it into the banking system. That was like a way to recapitalize the bank. It was also a way to track the money. And so now one of the benefits of the central bank digital currency is, instead of the Fed transmitting money policy by going to banks, buying bonds from banks, they could be transmitting monetary policy by giving, essentially directly to each individual. It could be your ID. I mean, India has been very forward thinking about, you could open a bank account with your biometrics. And so you could think about a way of directly communicating, directly giving cash or taking cash from people through these central bank currencies. Now, what that talks about is going away from the traditional banking system. So it gives a lot of fears to the bankers, and they're empowered in some ways by this sort of private banking system. It's also a very different reserve system. I mean, it gets to, one of the ways they transmit policy is that they lower rates, and then they believe that banks are going to then go out and do more lending. Here, who's going to do the lending? Who's going to do the credit control? So you need something to intermediate and help do lending. And so they in a way, they want to keep the banks in business without removing their core ethos. I don't know, that Jason looks like you want to.
I'm very upset. I'm very upset. Jason?
Look, you say that they're sort of empowered by that position. I think they're 100% empowered by like the essential oligopoly that they run on basic financial services that are required for everybody to live. Like, that's absolutely one of the biggest problems with the existing system, is the fact that they sit in this juncture that regulators like block new entrants to. They don't face competition, and it's why the worst consumer experience that you get in your life is from your bank. Right? It's because they don't face competition here, because they have got an oligopoly on that place in a required system. So I think that the idea that you would fundamentally try to protect that as you roll out a better system is not the right thing to do, like, to say it very kindly. I think that, there are different ways in which this could get structured. You're right that like credit intermediation is an important function in the market, like maturity transfers, moving from borrowers to savers. I think it was in Lagarde's kind of the panel that she was doing yesterday on this topic, 80% of the European M1 money supply is in commercial banking money, right? And that propagates as a result of that lending activity. But there isn't a need for them necessarily to run that privileged position on your daily financial services and your deposit taking to do that function. Like, we could envision a world where we've got a much more competitive sort of lending and borrowing ecosystem that's risk managed by firms like banks that are well capitalized and regulated, but that they would actually compete for your deposits based on providing attractive interest rates and enable like more of these guys so they become less systematic. There's a system that actually looks better that requires people to be more consumer focused on the things that matter to them if you break down that monopoly. So I think the idea that you need to protect that as your starting case for building a nominally digital ecosystem isn't the right starting place, right? You should start with like what empowers people the most. Access to credit is something they'll absolutely need, but protecting the bank's existing position or trying to replicate it across is definitely not where I would start.
It's something I don't understand this. And Jeremy, like, you can riff on this if you like, but people are already using stablecoins. Yeah, they're already running US dollars over their cell phones. They've already exited like the banking system. They're running on the cell phones on open source software. It's happening. It's rife in certain parts of the world. I don't understand why you need to go and build like an alternative system to replicate something that's already being used and is better than the incumbents. Though, Jeremy, like I leave it to you to run with that if you wish, or whatever else you'd like to say.
Well, I think one of the things as we talk about the poor user experience of banks and like what are we actually talking about? There's the digital experience where people are doing things in Venmo and others, and there are some new technologies that people are using to transfer money. But I think one of the key things that we've often talked about, I think we're gonna get more vocal about, is where do banks earn their money? It's because people leave their money in quote unquote cash. Yep. And now the Fed is over 3%. Are you getting 3% on your cash? No way. You're not getting 3% of cash. You're not even getting 3% of your savings accounts at these banks. And so what we're actually talking about is raising the cost of capital for the banking system, because as these new technologies come out, there's no reasons why you shouldn't always be earning money, the real rate of interest that you could offer on cash. And so as like an investor in banks, people have thought, rising rates, time to go along the banks. Well, technology might be disrupting them in some ways. And maybe that's not a 2022, 2023 event, but the next 10 years, I would be, you could say that the cost of capital is going to go up for banks. We have a front row seat to that. In terms of the other stablecoins, Jason, what I'm talking about is, being able to earn like interest income off your cash. A lot of people stake their dollar stablecoins to get cash. Is anybody doing that well today, do you think? Is that something that the big stablecoins are offering the yields that you could reflect in those sort of Fed funds rates today?
We've seen like rates that looked attractive in the past, but then we've also seen that a lot of what sits behind these lending pools, and I'm talking about the rates that you get from like staking them to DeFi, which I think is what you're referring to, Jeremy.
No, staking is different than getting the interest, because you could get the interest and stake as well, potentially.
Yeah, maybe. For sure. Right. So I think like interest bearing on like real world assets, on like lending to like, as part of a bond issuance or to like genuine economic activity for stable coins is pretty nascent right now, but it needs to grow. I mean, we're actively working on like tokenizing like real world assets and treasuries, etc. So like this is exactly the point of that, is that in this ecosystem, there is capital that wants a more stable, more secure, more trustworthy like rate of return. I think with everything, you need to kind of balance out the risk and reward. But like what's emerging, I think, is going to be like new business models and ways in which that capital can get deployed. I think you talk about the rising cost of capital for banks as they need to kind of compete for, allocations that they can then go and lend out. But they're going to need to go and basically court the piles of capital they're going to start building up inside the DeFi space. So I think there are lots of people out there that are starting to look at, hey, how can we actually, perform this function whilst accessing that capital through this set of rails being blockchain native that makes all these transactions more efficient. A lot of the stuff that's been out there today, we've seen kind of trouble with it in the last 6 months. Like Celsius is a really good example of kind of a way in which you can do this in a non-mismanaged way. Voyager is another example. So this is still a nascent space. People need to be careful, but, this is where there are more and more kind of trustworthy, more established people looking to be regulated, entering this space to kind of offer something that I think is going to be a more attractive business model for this kind of, yield generation going forward.
Yeah, indeed. A regulated alternative. That's certainly something that we now know and is public information that WisdomTree's been able to pull off and will continue to develop in the future. Regulated, transparent, a straight up version of what DeFi is, responsible DeFi. That's where it's going. And as the space grows and matures, that's what's going to be needed and is demanded. We're coming up on time, so I just invite, Jeremy first and then Jason, like any final thoughts there? It could be around what we've discussed today, or anything that you think that listeners should be paying a special attention to in the coming months.
It's been a very interesting macro environment. You didn't have any real yields on bonds. You're starting to get some real yield. So, the TINA trade, there's no alternative, is starting to get to be some real alternatives with real yields. So I think that's one of the interesting things. Let's see where rates go. I think there's going to be more volatility if the Fed continues down the path they're on. But, there's always hope that we can be convincing and they can see the light and see the data. And we'll be watching for that pivot. And we saw it from Bank of England today. Let's see how the rest of the world goes. But our view inflation is going to come down, and that sets the stage for a better move in risk assets when they start to recognize that.
Absolutely. And Jason?
I think that what we're seeing in the markets at the moment is like it's a really interesting time, right? We've seen this big period within the DeFi crypto space where there was a huge amount of demand for yield, primarily something that was just unachievable in the existing financial services system. And for the first time ever, people were kind of able to vote with their feet on where they wanted to go, and were choosing to go to this space because it offered something they couldn't find somewhere else. And what was being offered was, in some cases we've seen not as kind of stable as what you would like it to be, but for the most part has been very innovation focused on giving a better experience. And I think everyone out there at the moment that is, thinking about monetary policy, thinking about CBDCs, needs to consider this very, very carefully when they're trying to tackle like how they're going to manage their economy generally, what kind of services they're going to offer, what kind of experience they want people to have. Because your interest rates, the way you regulate your banks, the position that you give them in the market, what medium your currency is on, notes versus like commercial money versus a blockchain enabled money. This all feeds into that user experience that what you've got. And I think if you don't start listening to the people that are trying to exist inside of that system, they're going to get up and go and use something else. And it's super interesting because for the first time, that's really an option. The sort of entire history of a financial system has basically been you get what you're given. And even if you like the guys over the border more, you can't go and use it. Well, now we've got internet native infrastructure to run this. If you've got a mobile phone in your pocket, you can access something alternative. My favorite stat for this is more people now have a smartphone than have a toothbrush. This is accessible to a lot of people.
Yeah, absolutely. It's 2022, folks. And I'll tell you, like, I don't have time to talk about it now. It's like Albert Hirschman used to say, exit, voice, and loyalty. Well, the options for exit are now more than they've ever been because, as Jason says, more cell phones, smartphones than toothbrushes. So you got to get real and deal with reality. But hey, people get there bit by bit. Unfortunately, though, that means we're at time. I hope everyone's found today's podcast useful and informative. As a reminder, if you'd like us to cover any specific topics in future episodes, or if you just want more information, email cryptoclarified@wisdomtree.com. You can see Jason on the Bird app, Twitter @GuthrieFi. Jeremy is @Jeremy D. Schwartz. You can find me at Benjamin Dean. If you're in the US, check out WisdomTreePrime.com. Join the waitlist. You won't be disappointed. Thank you very much for listening, and I hope you have a good day. Ciao.
Thanks, Ben. Thanks, Jason.
Bye, guys.